Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to my weekly show here on StockCharts TV. Thank you so much for joining me here on our weekly show where we break down some of the tools and techniques that we use, talk about ideas, observations, strategies based on the rapidly evolving market environment, all featuring the benefits and power of the StockCharts platform, which I use every single trading day. What I'm going to do today is actually revisit some of the stocks that Grayson Rose and I talked about just at the beginning of September. We've gotten into a routine of doing a monthly show together where we talk about our top 10 charts for the month to come. Actionable ideas, charts that have compelling setups, and it's a great opportunity to talk about risk versus reward and how to screen for ideas and how to, just apply the technical analysis toolkit to current charts that we find compelling. Grayson and I talked after last episode, so we don't spend enough time kind of revisiting some of the stocks we talked about how they have evolved, because a big part of the technical analysis toolkit is in managing risk, right? Using stops and recognizing when your thesis was not good, or when you were right, staying right, and when you're wrong, getting out of the way as quickly as possible. So I thought I'd revisit the 5 names I shared in that top 10 episode. We'll put a link in the description so you can watch the entire episode if you want. I think it's well worth your time if you've not done so. A lot of great discussion about charting tools and techniques. But here we'll revisit those 5 charts that I shared. We'll see if Grayson Rose is courageous enough to revisit his picks. I don't know. Gauntlet thrown, Grayson Rose. By the way, before we get to my 5 charts and an update on what they're looking like here toward the end of September, quick reminder, if you're looking for my market recap show, that indeed runs every weekday after the close at 5 p.m. Eastern, 2 p.m. Pacific. You can find that on my YouTube channel called Market Misbehavior. We'll put a link below so you can access that anytime you want. You can watch all of our previous episodes on there as well. Also, the Market Misbehavior podcast. We've had some really good episodes here recently. We're almost to our 70th episode since launching the new podcast. My latest episode was with Peter Krull. Peter's a portfolio manager who runs sustainable portfolios with a firm called Earth Equity Advisors. He's author of an upcoming book called The Sustainable Investor. Had a lot of fun talking to him about sustainable investing techniques, ESG, SRI, all sorts of different things about gathering data, about analyzing returns, about diversification, and all things ESG. So if that's an area of investing that you've been intrigued by or that have tried to implement in your own portfolios, I think you'll find my conversation with Pete was pretty interesting. All right, here we go. I got to eat crow a little bit because one of these ideas definitely did not work out particularly well, but we'll get to that here in a moment. So I'm using the performance table here on StockCharts. One of the great things to point out is every time that Grayson and I have this discussion about our top 10 charts, or any time really I need to share a list of charts with anyone, I use the ChartList feature on StockCharts. And once you get it in there, what's really cool is you can look at a lot of really cool visualizations. You can do the ChartList view, which lets you look at all the charts here, in a row. We're going to look at that in a moment. We can look at what's called a candle glance. You can get a quick thumbnail preview of each of those charts. You can put them all into an RRG, for example, and look at the relative rotation of these charts. Or you can look at what's called the performance table, which allows you to quickly look at performance on a bunch of different time frames. Now, we actually identified these stocks just under a month ago, right? It's probably 3.5 weeks ago, but I'm using a 1-month performance, so it's not perfect, but just gives you a general idea of what these stocks and ETFs have been doing. Now, I put the S&P 500 in there just as a placeholder so you can get a sense of what the S&P did over the last 1 month. And as we can see here, up 3.6% as of when we're recording this midday on Monday, September 22nd. 2 of the charts that I shared have outperformed in a pretty dramatic fashion. American Express almost doubling that return in the last 1 month, up 7.2% in the last 1 month. The big winner is the Silver Miners ETF that I shared, ticker SIL. We talked about gold and gold stocks before. We talk about it quite often, though, so I thought it'd be good to shake it up and talk about some other precious metals still within that trade. And that remains a top idea in my opinion. Now, a number of things underperformed. Nvidia did underperform over the last month. It's actually up quite a bit today And it was actually a short idea that I shared. I talked about being short Nvidia and why, and just the investing case for that particular approach. Motorola also has lagged a bit, but still up 2.7%. It's pulled back here in the last couple weeks. Merck has been the worst by far. It's actually down almost 7%. That was one we actually talked about waiting for a trigger that just never came. And this is when, again, with Grayson Rose and I talked about these charts afterwards. So, we should revisit these and just, because a lot of times we share charts, but then you're not there looking over our shoulder as we look at those charts every day, every week, and the chart changes. And I think that's one of the great benefits of technical analysis. You're not just locked into a trade and then you hope it works. That's arguably sort of the fundamental approach. You find good companies and then you buy them and hope that the price goes up and that the market recognizes the thesis that you've been embracing. Charts are great because your report card is there in front of you, right? Your performance is very clear to see on the chart. And if the chart keeps working, you can keep the trade on. If it's telling you it's no longer a good trade or that your thesis was wrong, you get out of the way, right? And you go on to something else. So with that in mind, we'll look at the 5 charts here. I'm just going to get it out of the way first because and Grayson was a bit surprised when I said, all right, short Nvidia. That's my first, chart idea. And the idea, and I'll tell you what the thesis was. And again, I'd encourage you to go back and revisit the discussion. When we were recording that, it was here at the beginning of September. And what I had found was that the technology sector and certainly semiconductors were struggling from early August to early September. So right around Labor Day, I'm thinking, this is a group that's actually done quite poorly. So, and Nvidia was actually in the process of breaking below its 50-day moving average for the first time since, the end of April. So I saw that as certainly a period of short-term weakness. And the thesis was, what if this just continues lower, right? What if we break down through the 50-day and just keep going? And other sectors, other ideas had started to emerge in a position of strength, right? And it was things like other growth sectors, which I'll show you here in a minute, but also some value sectors like financials, maybe even some industrials had emerged and done quite well in the month of August. So the idea was, what if that trade continues? What if semiconductors and other leading growth names or technology names continue to underperform? And maybe this is an opportunity to sort of play that trade. Soon after we recorded it, it jumped back above the 50-day, went back below the 50-day, and then finished last Friday right at the 50-day moving average. Now today, on Monday the 22nd, we're seeing a nice rally across the semiconductor space, Nvidia included. It's very close to making it to another new high, which would be above 185. It actually teased that level earlier today. So at this point, right, if you're sort of playing the short side or playing the downside on Nvidia, for me, breaking to that new high would be the sign that, all right, clearly that wasn't a great approach. Clearly the market is, the stock is seeing a resurgence to the upside. The fact that we made a higher low last week certainly makes me a little less optimistic about opportunities to the downside. The fact that when that downtrend ended, we didn't get much below an RSI level of 40, which sort of implies that we're still kind of generally in a bullish frame of reference. So, semiconductors, it turns out, were weak just going into early September, and then from there, it turned around quite a bit. This is one of the charts that I was looking at before that episode. And what we talked about was the fact that technology had really started to underperform. Here's the relative performance of the technology sector. And then below that, the relative performance of communication services and the relative performance of consumer discretionary. We can see in the month of August, technology actually underperformed. That's after outperforming almost consistently off of the April market low. End of July to beginning of September, tech underperforming. Other growth sectors actually emerged in a position of strength. You could see communication services and consumer discretionary both outperformed in August. So when I'm looking at this chart, I'm thinking, all right, maybe this is the beginning of further deterioration in technology, and we're seeing emerging strength in other areas. What's happened so far in September is that technology has gone right back into a leadership role, and that's really accelerated as the month has continued. We can see that communication services and consumer discretionary both have outperformed quite well. They actually lightened up a bit going into last weekend. And so far today here, again on Monday the 22nd, both of those sectors are actually pulling back a bit. So it almost looks like a resurgence back to this technology-driven, semiconductor-driven bull market phase. And again, my sort of assumption was this is the beginning of further deterioration. I need to rotate away from those stocks into other names. Markets turn very, very quickly. And again, that's one of the things I love about charts is that they tell you when the condition changes, right? So if you're assuming this price is going to go lower, you always want to think, all right, what would tell me that this chart is no longer bearish? And for me, getting above 185 would be the level. We're not quite there, but pretty close to where I would say this is an all clear kind of upside breakout type of chart. For now, it's just a short idea that did not work particularly well just yet. Chart number 2. Let's get away. Let's forget that one ever happened. And I say that with a great deal of sarcasm. Don't forget those ideas that don't work. I mean, I think that's one of the great benefits of charts is that you can treat them as a learning opportunity, right? When your thesis doesn't work, go back later and think about, what did I miss? What could I have, what did I get out of that trade effectively, right? Did I recognize that the conditions had changed and just learn from that as much as possible? So for the next opportunity, you're just better equipped. Let's get to some charts that actually worked out as we expected. American Express is one of those. This was, has outperformed the S&P over the last month. And when we were doing the episode, we talked about a potential cup and handle pattern. We talked about the 21-day EMA, which is one of my favorite ways of just tracking an uptrend, right? And in a stock that's showing a lot of strength, that 21-day EMA can be a great lagging indicator just to make sure that you're locking in that upside as much as possible. We can see that in the second week of September, indeed, American Express went from making a brief new 52-week high to pull back to an ascending 21-day EMA, and then over the last week, it's just popped to the upside. So at this point, I would say this is a chart that's actually showing quite a bit of strength. As we assumed, right, with that setup, the discussion was cup and handle pattern means, to be validated, we need to break above that neckline. And that's really what happened last week is we finally broke above the neckline after pulling back to the 21-day EMA, making new 52-week highs. This is the kind of chart that I assume is innocent until proven guilty. And I think the action in the last week sort of supports that general thesis. Motorola Solutions MSI was the third chart that I shared in that special episode. And on the chart of MSI, it's kind of doing what AXP did, in that it's pulling back from a new high, although in this case it's a new 6-month high, breaking up to 490 now, just in the last week, pulling back to an ascending 21-day EMA. And as I mentioned, this is an approach that I've used very, very often in my own portfolios. Look for charts showing quite a bit of strength, pulling back to an ascending 21-day EMA. That oftentimes ends up being a great sort of secondary entry point. Then when we start to break below the 21-day EMA, that's when you want to revisit it and say, okay, maybe there's something more significant happening here. So I'd say it's right at that point where you might want to start revisiting it. But overall, I see a chart making higher highs, higher lows. One of the things you look for when a stock's making new price highs is it also showing stronger momentum. The RSI actually became overbought on that most recent new high around 490, second week in September. So I would say overall that's pretty decent. So pulling back a little bit, but for now making higher highs and higher lows. At this point, I think that's still a strong chart until proven otherwise. And for me, proven otherwise means we at least break through the 21-day EMA. That's when I would revisit it. For now, still a pretty good chart. All right, the fourth name that I came up with was Merck, and I will tell you, Merck just never made that trigger that we talked about. When I look at charts like this, and particularly, if you've followed my work for any amount of time, you'll know I'm more of a growth-oriented, what we call a momentum investor or a trend follower. My goal is to find strong charts that are in a position of emerging strength to get in and to ride that uptrend as long as possible. It's like the general thesis of what I'm trying to employ. However, I think it's always interesting to look for what I'd call bottom fishing candidates, right? Stocks that to the contrary, have actually been beaten down for quite some time, are showing signs of new strength. And maybe that's an opportunity to ride it to the next leg higher, or at least buy into a rotation. It's not my primary way of approaching things from a technical perspective, but certainly something I've done, and I'm always on the lookout for good opportunities. What attracted me to the chart of Merck going into that discussion a couple weeks ago was, from a longer term perspective, obviously a very bearish pattern here from the second half of 24 to the first half of 25. Spent almost that entire time below a downward sloping 50-day moving average. That's just not a good trend. But something interesting happened at the April and May lows, right? We made a new low around 75 in April. We made another low around 72 in early May. We're oversold on that first low, but we're not oversold on that second low. That's a bullish momentum divergence, suggesting or implying that downtrend may be at an exhaustion point. From there, sure enough, we've made some higher lows. And going into the episode, we're kind of right below the 200-day after testing it here. So my comment was, we're kind of we're between these two moving averages. Until and unless we can get above the 200-day moving average, I'd be avoiding it, right? And that's kind of how I approach a chart like this, something that's been beaten down for so long. I think Paul Tudor Jones was spot on when he said something along the lines of nothing good happens below the 200-day moving average. When something's been in an established downtrend, I'm happy patiently waiting for a break above the 200-day to validate that uptrend and to say, all right, now this is different. This is a different trend and starting to show real signs of accumulation. We talk about that here, and if you look, we just haven't seen that breakout, right? So I think of a chart like this as like an if-then statement. If we can get above the 200-day, then I take a position, and then we think about some upside targets and use things like Fibonacci retracements and other techniques like support and resistance levels to identify some upside targets. But until we break above the 200-day, it's not ready yet. And I would say this is still simmering, but not boiling, if you know what I mean. To the contrary, and I would say just in the last week and a half, we talked about being between those two moving averages, kind of being in limbo. And so instead of breaking above the 200-day, we actually did the opposite. We broke below the 50-day, which I would say sort of reinitiates this as a general downward trend. So I would say Merck, I don't mind having that as a potential idea. This is the kind of chart I'd put on a watch list and just wait patiently to see, does it get above the 200-day moving average? And if so, then I revisit the chart. That trigger just never happened. So for me, no harm, no foul. Trigger never came. I move on. Hey, I'm glad we're finishing with a chart that worked quite well, which is the chart of silver miners. And what again, I often think about what lessons I'm learning through the course of the year. And at the end of the year, I always do an exercise called the 10 questions, where I look back at the year that just happened and I ask 10 questions that sort of address issues of performance and idea generation and risk management and process and routines. And it's a routine. It's an exercise that I've done for many, many years, and I'll do it at the end of this year and certainly share my takeaways with all of you. And I would encourage you to do something similar. You'll get more of that toward the end of the year. But one of the things that I think I will be reflecting on is being confident to stick with trends that are working. When people when I suggest charts that are just breaking out, I always get people pushing back, saying, "Well, we missed it, right? It's too late. How can you be buying when it's already up so much?" And if you look back at the charts of gold and silver over the last couple of years, how many times could we have claimed it was way too late? Same with charts like Palantir that had incredible gains over time, or Nvidia, or any of those long-term growth stories that have just had incredible runs for multiple years. There's so many times along that way up when you can complain about, well, it's too late. Too late, I don't think is a real issue, right? As much as we think it is, right? We're nervous about top ticking a chart, but one thing I've learned as a trend follower is strong charts tend to remain strong until something changes. And so, I think, when we talked about silver miners and gold and other precious metals, these are charts in strong uptrends. They're making higher highs and higher lows. The moving averages are in a proper order, which means we have the price above the 21-day, which is above the 50-day, which is above the 200-day. That's how I think of that structure. It's becoming overbought on new highs, which is bullish as well. So silver, the silver miners ETF SIL up about 25% in the last month. Could it go higher? I think it could, right? And as a trend follower, I assume that trends like this will persist until proven otherwise. And that's when I think techniques like moving averages can be so vital, right? Until we break the 21-day EMA, it's not even worth worrying about. Until we break the 50-day moving average, it's not anything to really probably take much action about, which means we've got plenty of room for noise, pullbacks, choppiness. And as long as we hold the 21-day EMA, conditions are still pretty good. For now, I don't know what you're seeing, but this is a chart still going up and to the right. So there you go. That is how I would break down the 5 charts that I provided early September. And again, this is an exercise I would encourage you to do in your own work, right? If you come up with a particular set of charts, if you find ideas from StockCharts TV or other places and start following them and tracking them, follow up, right? A couple weeks, couple months later, and just think about what was the original thesis, what changed, at what point would the chart evolve to the point where I think my original thesis is no longer valid. That's how you make sure your risk management approach is good. Did I stick with trends that I thought were going to work that did work? That's how you make sure you're doing a good job following trends and not getting scared out of things too early. But by going through calls that you've made, good ones, even not so good ones like my Nvidia call, granted was not a great one. Hey, you have to be honest. I think part of being a mindful investor is being a humble investor. And that means acknowledging when your thesis didn't work, learn from it, make appropriate changes, be better prepared for the next chart. What did you think of these of charts? Any things that you've been thinking about in September that surprised you? Make sure you drop a comment below and let me know. That'll do it for today. I'm Dave Keller with Market Misbehavior. As a reminder, we do a live market recap show every weekday after the close. Also do a Market Misbehavior podcast where I recently interviewed Pete Krull, who's a portfolio manager in the sustainable investing space. You can find both of those shows and a lot of great other educational content on my YouTube channel called Market Misbehavior. For now, I will say have a great one, be safe, and remember, it's always a good time to own good charts.